Welcome to the deep dive. Today we're taking a close look at Godawari Power and Ispat Ltd, GPIL.
Right.
We've got a really interesting set of documents here. Their recent Q4 and full year FY25 earnings call, the investor presentation that went with it, and also an analyst report from MNCL giving an outside view.
Yeah, that analyst take is always useful.
Exactly.
Yeah.
So our mission today is basically to cut through all that detail and give you the essentials, how GPIL did, what they're planning, and how the market sees them right now.
Absolutely. And having those different viewpoints, the company's own words, and then the external analysis really helps build a more rounded picture of where GPL stands and where it might be headed.
Okay, let's jump right in then. Financial performance, the big picture first. FY25, what were the main takeaways?
Well, the first thing that jumps out is this kind of split between production and actual revenue. On one hand, FY25 saw their highest ever production for things like sponge iron, steel billets, ferroalloys, power, which is great, operationally strong, but, and this is the key bit from their reports, the prices they actually got the realization for most of those, well, it dropped, down by 1 to 8%, except for ferroalloys.
So price pressure.
Exactly. So even though they made and shipped more stuff, the overall revenue for the year was basically flat compared to FY24.
Right.
And that naturally flowed down to EBITDA earnings before interest, taxes, depreciation, amortization, and profit after tax, POTT. Those were also lower year on year because of that price squeeze.
So making more, but the market just wasn't paying as much. That puts the damper on things.
Yeah.
How did the last quarter, Q4 FY25, look specifically?
Q4 was a bit more positive, actually. If you compare it quarter on quarter, revenue went up. Although it was still a little bit lower than Q4 the year before. Again, those price issues still lingering.
Right. Persistent issue.
But the really noticeable thing was the big jump in Q4 EBITDA and PAT compared to Q3. We're talking like 44% and 53% increases.
Wow. That's a huge leap in just 3 months. What was behind that strong finish?
The company put it down mainly to higher production and, crucially, higher sales volumes for specific things. Iron ore pellets, galvanized products, and rolled products.
So they managed to move more volume in key areas.
Seems like it. Like they cleared out inventory and maybe hit some pockets of good demand, which, helped offset the lower prices per unit.
So despite the broader pricing headaches, they're still keeping profitability at a decent level.
Absolutely. Even with those realization challenges, their overall FY25 margins were still pretty solid. EBITDA margin at 22%, PAT margin at 15%.
That's strong.
Yeah, it suggests their operations are fundamentally efficient, good cost control. And another thing, they finished the year with a really healthy net cash position, INR 863 crores as of March 31st.
That's a nice cushion.
Definitely. And good news for shareholders, too. They recommended a dividend of 1 rupee per share. That's like 100% payout based on the share capital.
Okay, that strong cash position gives them options.
Yeah.
Let's pivot to operations then and what they're expecting going forward. Sounds like they mostly hit their FY25 production targets.
Yeah, largely they did, either met or even beat them in some cases. The earnings call specifically mentioned ferroalloys doing really well, 126% of target.
Wow.
And rolled products were strong too, 106%. Pellet and sponge iron production were pretty much flat, kind of in line with what they guided for.
Okay. Now, on the iron ore mining side, I saw something about a new mine, Boria Tibu, but also some issues.
Right. So Boria Tibu starting up was a boost to their mining capacity, but yeah, the call mentioned a temporary halt there.
Why was that?
Seems like some delays in getting permits renewed. Standard procedural stuff, hopefully. The company sounded confident it'd be sorted out soon, expecting to restart by end of May or maybe early June 2025.
Okay, bit of a hiccup in ramping that up. Now, sponge iron production took quite a dip in Q4 compared to Q3. Was that market related?
No, actually, that was interesting. That fall in Q4 sponge iron wasn't about demand. Management explained it was planned.
Planned? How so?
Well, they'd hit their full capacity, 5.94 lakh tons, around mid-February, so they deliberately took some downtime for modifications.
Upgrades.
Exactly, on some kilns and turbines, aiming for better long-term efficiency. So we should probably expect similar lower volumes in Q1 of FY26 too, as they restart those modified units.
Right, makes sense. Planned maintenance for the long run. Now, pellet sales looked really strong in Q4. What drove that?
Yeah, big jump there. The main reason, according to the call, was they made a concerted effort to clear out a bunch of inventory that had built up in Q3.
Okay, shifting stock.
Right. Plus, remember those kiln modifications for sponge iron? That meant they used fewer pellets themselves internally during Q4.
Freeing up supply.
Precisely. So more was available to sell. They mentioned a tiny bit of exports in January, but almost all of it was sold domestically.
So Q4 pellet sales were probably a bit unusual because of that inventory clear out and lower internal use. Looking forward to this year, FY26, what are their production targets? What are they guiding for?
Okay, yeah, their FY26 guidance gives a clear picture. They're targeting 3 million tons each for iron ore mining and pellet production.
Okay, 3 million tons each.
Yep. Then for the other main products, sponge iron, back to 5.94 lakh tons, steel billets, 500,000 tons, rolled products, 375,000 tons, and ferroalloys, around 90,000 tons.
So kind of getting back to a more normal run rate after those Q1 modifications settle down.
Seems like that's the plan, yes.
Okay, sounds like a clear operational roadmap. Let's talk growth then. CapEx, they've got some pretty big expansion projects lined up, haven't they?
They definitely do. The big one is at the Ari Dongri mine. They want to massively increase capacity there from about 2.35 million tons up to 6 million tons a year.
Wow, nearly tripling it.
Huge step up. They're expecting final approval by Q3 of this fiscal year, FY26, though they did flag a small delay. Seems some extra testing was needed by the authorities.
Okay. But still aiming for Q3 FY26.
Yeah, they sounded optimistic they'll get the clearances by then.
That's a major move for their raw material security.
What else is in the expansion pipeline?
Well, there's the 2 million ton pellet plant expansion that's apparently on track, scheduled for commissioning in Q2 FY26, so pretty soon.
Okay, another big capacity jump, definitely. And they're also bumping up their steel melting shop capacity by 50,000 tons. That'll take it to 575,000 tons total, expected by Q4 FY26.
And they need power for all this new production, right? Are they expanding that too?
Precisely. They're adding another 125 megawatts of solar power capacity.
Wow.
Yeah, that'll bring their total captive solar to 290 milliW. Helps manage energy costs and, fits with sustainability goals too. They said land's acquired, contracts are finalized, so that seems well underway.
So a lot of moving parts, all interconnected growth. What's the total bill for all this in FY26? The CapEx budget.
They're estimating total capex for FY26 somewhere in the range of INR 950 to 1,000 crores.
Okay, significant investment.
Yeah, it covers quite a bit. A beneficiation plant that's for improving work quality, the pellet plant expansion we mentioned, the big solar project, and also various, energy efficiency upgrades across the board.
Good to see that focus on efficiency alongside growth. Speaking of which, let's touch on decarbonization and sustainability. What are they doing there?
Yeah, this is becoming increasingly critical for investors and stakeholders. GPIL seems to be taking it seriously. They've set a long-term target, net zero carbon emissions by 2050.
Ambitious for this industry.
Very. And they've got some concrete steps underway. They signed an MOU with Siemens Energy for a waste heat recovery project that's due by March 2026.
Okay.
And they've also issued a letter of intent to IIT Mumbai. This is for a 5-ton per day carbon capture unit, also targeting March 2026 completion.
Interesting. Tech collaborations for carbon reduction. Anything else on the sustainability front?
Yeah, some more immediate things too, like swapping out diesel and petrol vehicles for EVs for internal transport.
Practical steps.
Right. And they did point out that their CO2 emissions per ton of steel have actually been coming down over the last 3 years, so a positive trend there.
Good to hear.
And one more thing, they started getting ESG rated. Care Ratings gave them an initial score of 3, which is okay, with a numerical score of 51. They said they're actively working to improve that.
Okay, so a multi-pronged approach to ESG. Now, let's shift gears slightly. The acquisition of Jammu Pigments Limited, JPL. That seems like a move into a different area for them.
It is, yeah, a diversification play. In FY25, GPL bought a pretty big stake, nearly 44% in JPL, and JPL is in non-ferrous metal recycling. So, yeah, different from steel.
Okay. And is JPL a significant business? What were its numbers?
Seems quite substantial already. The Paul mentioned JPL's FY25 figures, net sales of INR 860 crores, EBITDA of INR 79 crores, and PAT profit after tax of INR 37 crores. Q4 was also strong for them.
So profitable and generating decent revenue. What are GPL's plans or expectations for JPL?
Management sounded pretty upbeat about JPL's potential for volume growth.
Right.
They said they're working closely with the JPL team, the original promoters, to boost productivity across JPL's operations.
Makes sense.
They did add a little caveat, though. JPL's margins might bounce around a bit quarter to quarter. Depends on their product mix, They're trying to focus more on the higher margin stuff, like tin, cadmium, zinc. But overall, GPIL definitely sees this JPL investment as something that will add value for shareholders down the line.
Interesting. Diversifying into recycling could be a smart hedge against the ups and downs of the steel market.
Yeah.
Okay, let's talk markets then. Iron ore, pellets, what's the outlook there? Global first.
Globally, GPIL reckons iron ore prices will probably stay in the $90 to $105 per ton range for FY25. Right now, it's around $100.
Okay, relatively stable range.
Sort of. They do see potential for prices to soften a bit in the second half of the year, maybe due to more supply hitting the market.
Mm.
But on the flip side, they're kind of hopeful that stimulus measures in China, especially if the housing market there stabilizes, could help prop up prices. It's a bit of a balancing act.
Always is with China. And what about domestically? Within India, what's happening with prices here?
Domestically, the trend for iron ore, specifically the benchmark NMDC Fine 64F, is actually upwards. It's around INR 5,500 per ton currently.
And what's driving that?
Seems to be rising steel demand within India itself. A big factor is the government's push on infrastructure spending.
Right, that huge CapEx plan.
Exactly. GPIL mentioned that INR 11.2 trillion earmarked for infra in FY26. That's a 10% jump from last year. That fuels steel demand.
Okay. And pellet prices domestically.
Domestic pellet prices are currently trading somewhere between INR 9,000 and INR 10,000 per ton. GPI expects them to kind of fluctuate in a INR 9,000 to INR 11,000 range in the near term.
That government infrastructure push really sounds like a key positive factor for domestic demand. What about that safeguard duty on hot-rolled coil? Did that affect pellet prices much?
It did initially. When the government put that duty on HR coil, it created some positive sentiment, and pellet prices ticked up temporarily.
Okay.
But GPIL said that effect mostly wore off. Prices kind of drifted back down as demand softened a bit, partly due to the monsoon season approaching.
Seasonal effects too.
Right, so GPIL hasn't really taken any major price hikes for pellets in Q1 FY26 compared to Q4 FY25. They also mentioned export prices for pellets aren't great right now, actually lower than domestic by maybe $15, $20 a ton.
So domestic market is key.
Definitely seems that way. And interestingly, they pointed out some regional differences too. Like the Bengal and Odisha markets are apparently oversupplied with pellets right now. But the Raipur market, where GPIL is based, is seeing strong demand, mainly because more DRI capacity, that's direct reduced iron, key for steelmaking, has come online there.
Fascinating. Regional dynamics really matter. Okay, finally, let's bring in that analyst view, the MNCL report. What was their take on GPL?
Right, MNCL, they kept their BUY rating on the stock, which is positive.
Okay.
But they did lower their target price a bit, down to INR 240 from INR 265 previously.
By the cut.
Mainly because they trimmed their earnings estimates for GPL. That cut was partly offset because they rolled their valuation forward, but still a net reduction. They noted the strong pellet sales in Q4, but also flagged the impact of lower realization and higher employee costs on the financials.
Okay. And what about that mining expansion delay? Was that a concern for them?
Yes, that was a key point in their report. The delay in getting the environmental clearance, the EC, for the Ari Dongri expansion, now expected Q3 FY26, is a definite concern for MNCL.
How so?
They think this delay will mean higher iron ore costs for GPL in FY26 because they'll have to rely more on ore from the Boria Tibu mine, which is higher cost, and potentially buy more ore from the open market.
Right. Impacts their cost structure in the near term. What else did the MNCL analysis highlight?
They also mentioned a couple of other things impacting their earnings forecasts. Changes in how JPL's financials are consolidated and how billets are transferred to the new rolling mill. Accounting stuff, basically.
Got it.
But looking further out, MNCL actually expects GPL's profit margins to keep expanding.
Oh, interesting. Why is that?
They see a few drivers. Higher contribution from pellets, which tend to have better margins. Less need to outsource structural steel once their own facilities are fully ramped up. And, critically, they expect the new pellet plant won't need any external ore from FY27 onwards.
So longer-term optimism on margins due to integration.
Exactly. Their valuation is based on 6 times EBITDA for March 2027. The main risks they see are, well, commodity price swings, which is standard for this sector,
Sure.
and any more delays in getting that Ari Dongri mining EC. That's the big one to watch. They also estimated FY26 capex around INR 8 to 9 billion, slightly lower than the company's range, and gave detailed projections for where GPL would get its iron ore in FY26 and FY27.
Okay.
Oh, and they mentioned the new steel plant will be a greenfield project focused on structural steel.
Right. A mix of near-term caution around costs, but longer-term optimism from the analysts. Okay, let's try and wrap this up. Bringing our deep dive to a close, what are the absolute key takeaways on GPIL?
Well, in a nutshell, GPIL showed really strong production muscle in FY25, hitting record levels. And they've got clear, ambitious plans to grow further, especially in mining and pellets. That backward integration is key.
Right.
Now, they are facing some immediate headwinds, those lower selling prices, the delay in the big mine approval. That's undeniable.
Yeah.
But their underlying profitability is still solid, and they have that strong cash position. Their focus on integration, adding value, plus the sustainability push positions them well if they execute properly. And don't forget the JPL acquisition adds that new non-ferrous recycling angle.
Okay, so what should you, our listener, really keep an eye on going forward with GPL?
Several critical things, I'd say. First, that Ari Dongri environmental clearance, getting that on time or close to it is vital for their costs and raw material security.
Definitely number one.
Second, watch the commissioning and ramp up of the new pellet plant and the rolling mill. Need those to run smoothly to hit the volume targets.
Right. Execution risk.
Third, how does JMU Pigments perform? How well is it integrated, and what does it actually contribute to the bottom line?
Yeah, track the diversification.
And finally, of course, just keep watching the markets. Global and domestic prices for iron ore, pellets, steel, that will always be a huge factor for their profitability.
Absolutely. Some really clear points to track. Okay, let's leave you with a final thought then. As GPIL pushes ahead with these big expansion plans, navigating the usual market ups and downs, the big question is, how effectively will this strategy focusing on value-added products and locking down their own resources really build a lasting competitive advantage for them in this tough, ever-changing steel industry?
That's the core question, isn't it?
It is. Thanks for joining us for this deep dive.